So what did you make of the quarter-point cut and also some of the commentary from Jay Powell, just talking about the dispersion, the summary of economic projections, and also our Steve Leisman asked a great question, are we on a path for cuts? And Jay Powell came back and said, well, we're more data-dependent, something that he obviously has said in previous meetings.
Well, the meeting turned out to be what most of us expected to have happen, the 25 basis point cut. I think what would have been more problematic was we didn't get dispersion of views given the economic environment in which the Fed is operating. And I think the chair pointed out, there are two-sided risks here. You have to weigh the risk of higher inflation, which we think we're going to see because of the tariffs, versus a weakening, softening job market. And I think that's what the Fed sort of talked about around the table, is how to balance those risks. And different policymakers came up with different answers about what the best policy would be, monetary policy would be, to get back to full employment and stable prices. So again, I'd be more worried if we didn't see dispersion than seeing dispersion. I mean, it's, the median dot kind of summarizes across people, but that dispersion shows you there are some policymakers who are weighing the inflation risk still being the salient risks. And you saw that a large number of them have, fewer than the 3 cuts in the median. And then there's some that are probably weighing the labor market risks, downside risk to the labor market more heavily at this point. And so they built in more cuts.
So speaking of the labor market, it seems like Jay Powell confirmed what a lot of people were thinking, is that the Fed is more focused on the labor part of its dual mandate, labor and inflation. It's more focused on labor right now. I want to play a soundbite from you from Jeffrey Gundlach from Double Line Capital. What he said about the Fed's focus on the job market, and maybe, in his opinion, maybe they should switch it to something else. Take a listen.
I think there's a risk there of over-easing. I hope that they start focusing, and I think they will if I read carefully into what Jay Powell said. They need to look at the unemployment rate more than the jobs creation. It always used to be the jobs creation, but now with this negative immigration and with the downward shift in demand for jobs, supply for jobs, I think we really need to focus on the unemployment rate.
So, Loretta, your take, I mean, it's an interesting point he certainly brings up, the unemployment rate as opposed to job creation. We continue to kind of see the markets react to the jobs number itself. But what about the fact that the unemployment rate has ticked up? Still pretty close to historical lows, but it is ticking up.
Well, I think the Fed's going to look at all those data, but I agree totally with Jeffrey that there's supply issues going on in the labor market as well as demand. And so if you think, well, how much, labor force growth do you need, or payroll growth do you need each month to keep the unemployment rate constant? A lot of estimates are in the, 50,000, 30 to 50,000, 40 to 50,000 range. And we've seen the last couple of months the labor market not produce that many. So again, you see the tick up in the unemployment rate, but not a huge tick up yet. And so what the Fed, I think, is trying to do is manage that downside risk to labor, at the same time leaving policy somewhat restrictive because they do have this higher inflation. And the higher inflation is not necessarily only because of tariffs. If you look at core services, taking out housing, that has been, sticky. And so they're going to have to continue to look at the inflation part of the mandate. I didn't read the press conference or the statement coming out of the Fed or even the SEP saying that they're wholly just looking at the labor market. I think they're trying to do this careful balancing, but it's difficult. It's a challenging time for them. And so they're going to have to do this meeting by meeting. I think the lean is towards a few more cuts, but I think they're going to have to play it as the economy plays it.
Are you at all worried about stagflation? That was something we were worried about just a few days ago. Jay Powell addressed it somewhat. We talked about the retail sales numbers being stronger than expected, and someone asked him, are you concerned that it seems like it's the majority of that spending is coming from higher income Americans? And he said, well, the spending is increasing. Is stagflation something that you're worried about?
So right now, I think we've got evidence that the whole economy is holding up better than anyone would have thought, after the big tariff announcement in April. So the economy is more resilient, and oftentimes the economy proves to be more resilient than we all think it is. And so that's a good thing. And then we know next year people are going to get higher tax returns, and they're going to get refunds that they weren't necessarily building into there. So there's good things going on in the economy. We are in a soft patch in terms of economic growth, and we've seen the labor market slow. I don't think it's falling off a cliff, but it is softening. And so that's the balancing act. So I think this shock that we have, the terrorist shock and other shocks, tend to dampen growth and increase in inflation. And that's sort of the difficulty here for a Fed that's trying to balance both parts of its mandate.
Yeah, important point. The Atlanta Fed has Q3 GDP at 3.3%, so showing a pretty strong reading, at least a forecast there. I want to ask you one other question while we still have you. How does the Fed balance the AI impact or the potential impact on the job market? One of the things that Jay Powell mentioned is that some of this economic strength is coming from AI, the build out and just the CapEx spending there. But at the same time, it certainly has the potential to impact the job market. I'm thinking of yesterday of Lyft's announcement with Waymo to do autonomous driving in Nashville and looking at some other cities. I mean, we're seeing potentially the impact of AI taking away jobs, especially on the lower income side of things. How does the Fed balance that going forward?
Well, some of those kind of impacts from AI are going to play out over time. So what the Fed has to do is it has to build in a different perhaps trend and then make sure that it's setting policy to sort of dampen or expand on the cyclical part of that around that new trend. So that's also making it difficult because right now we're seeing a trend, right, because of immigration that we have lower supply. So they will take it into account, but it's going to play out over time. And largely what the Fed can do with its monetary policy is affect the demand side of the labor market rather than the supply side. So again, another challenge that the Fed's going to have to handle going forward, but again, over a longer time period.